This is MarcoVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MarcoVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Listeners, you're going to find a download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MarcoVoices.com. Just go to our homepage, MarcoVoices.com, and click on the button over Mike Green's picture saying, looking for the downloads. Now, Eric, let's cover crude oil.
EIA inventory data was delayed by the holiday week, so I don't have that, although API data suggested that there's been another large build offset by large product drawdowns. Looking at the price chart, it seems kind of unremarkable at first glance. The market's tried but failed to get over 78.50 several times now, and looking at the price chart alone, the market looks kind of fatigued with not much hope for that rally to continue. But the term structure chart tells a radically different story, with front-of-curve time spreads blowing out to steep backwardation. There's almost certainly a fundamental driver for that backwardation, but I have to admit I'm not sure what it is. I've been focused on other things this week. The steep backwardation at the front of the curve is often a leading indicator of higher flat prices to come, but that signal is usually only a day or so ahead of the flat price move. The sharp rally in front-of-curve time spreads has been going on for over a week now with little follow-through on the flat price chart, and frankly, I'm not sure what to make of that.
Eric, as oil trades toward that 78.50, I mean, you were talking about it failing to break out, but it also isn't breaking down off that. So many times that resistance level is tested until it's broken. Right now, we've seen for the last month, actually last 2 months, the sequence of higher highs and higher lows and general accumulation sitting above its moving averages. I think it's prudent to give the bulls the benefit of the doubt that they'll be able to still break that 78.50 level. If it does, I think a very reasonable target is the mid-80s, where the Fibonacci zones lie, and the entire oil complex is quite oversold. So anticipating some sort of a mean reverting rally, I think it's a very realistic case to be looking for. Nonetheless, I want to move on to equities. What are your thoughts here, Eric?
I think the market's in a tug-of-war between two narratives. The first narrative says this market looks awfully toppy, with huge breadth divergences and just a handful of stocks carrying the indices higher despite lackluster performance of the broader market. All of that is very bearish. On the other side of the tug-of-war is the narrative that, hey, it's an election year, the fix is in, and the Fed has already indicated their intentions to begin cutting rates soon, which everyone assumes is certain to take markets even higher. Wednesday's FOMC minutes revealed that the FOMC members are more worried about cutting too soon than cutting too late. To my thinking, that also implies that if the data change and inflation really has bottomed, as Jim Bianco has suggested it may have, then it's still possible we get no cuts at all this year, or maybe even a rate hike before the election. Now, I'm not saying that will happen. In fact, I still think it's unlikely. I am saying it's possible, and I think a lot of people are assuming it's not possible. So if it did happen, I think the market would be caught off guard and panic very quickly, as almost nobody is hedged for that outcome. So I think the March 12th CPI report is going to be far more important than most CPI reports. A miss on inflation expectations would cement in place the complacency we already have that rate cuts are just around the corner and the market is sure to rally through the summer into the election. But a second hot CPI print in a row, coupled with this week's FOMC minutes indicating the FOMC may be less dovish than previously thought, could be the catalyst to knock this entire house of cards down. So I'll have my eyes glued to my screens at 8:30 in the morning on Tuesday, March 12th, when the next BLS CPI report is released.
All right, well, I want to get Nick involved in this conversation. Nick, let's just first start off with talking the levels on the S&P 500.
Yeah, Patrick. So right now, the spot price on SPX is approximately $49.80. We have a call wall above at 5,100 and a put wall far below at 4,500. The implied move for the March 15th monthly OPEX is plus minus 120 points. Therefore, the upper implied move is 5,100, right at that call wall, and the lower implied move is 4,860. Right now, we have key resistance at all-time highs of 50.50 and key support at 4,900. I'm thinking that we're going to see a push toward that 5,100 mark on the back of NVIDIA's strong report, but I do think we see a window of weakness into the March OPEX down toward 4,800 perhaps. What the cause is, I don't really know, but again, I think we've ran too far too fast, and I think that a pullback is in order.
I generally agree with you. I mean, it was always going to be about this FOMC meeting minutes and the NVIDIA earnings, and right now the market is interpreting it bullishly. There are measured moves up to that 5,100 to 5,150 area, so this could spur a very short-term bull impulse to the very levels you were just identifying. And overall, the market is just overextended, and so it's gonna. The one thing that I watch quite a bit on is on page 5 here, Nick, we have the percentage of stocks on the New York Stock Exchange trading above their 50-day moving average, just to get a gauge on the market breadth. And what we continue to see is that this really is a rally, just being driven just by the few number of stocks of Amazon, Meta, and now NVIDIA that are pushing this index higher, but that we haven't seen the breadth widen on here, which basically means that these major Mag 7 stocks have to do all of the work to keep pushing this higher. And that in itself, I think, will lead to that exhaustion point that you were referencing. At some stage, we're going to see a correction. Right now, with this type of a breakout here, we're going to certainly give the bulls the benefit of the doubt to see whether or not they can make that higher high in the coming day. Now, Nick, let's move on to the NASDAQ. What levels are you watching on the Qs?
So spot price right now on Qs is approximately 432. We have a call wall above at 440. And we have a put wall below at 410, which are previous all-time highs. The implied move for the March 15th monthly OPEX is plus minus 16 points. Therefore, the upper implied move is 448, and the lower implied move is 416. Again, as I said with SPX, I'm inclined to think we see a push toward that high, perhaps touch 445, 450, before seeing a pullback down to the area of 415, 410 perhaps, which are the previous all-time highs. I think we've gone too far too fast. And what I'm seeing too is, as you alluded to earlier, the Mag 7 is actually kind of weakening overall because a few of the names are lagging. So Apple and Tesla, for example, are not really participating too much in this overall rally. As you said, Amazon, Microsoft, Meta, and NVIDIA are primarily driving this rally higher. So even less breadth than we've seen before in the Mag 7. I don't think it's sustainable at all whatsoever.
This interesting observation is that the S&P 500 looks like it's about to make a higher high before the NASDAQ is. And that actually shows that when you leave these 3 to 4 stocks that are doing all of the work, the breadth actually on the NASDAQ is deteriorating. I mean, only 45% of stocks on the NASDAQ are actually above their 50-day moving averages. The breadth is far worse than it is on the broader markets. And so what you have is a few of these mega cap names that are doing all of the work there, and even more distinct deterioration in the prices below. And you can see that the NASDAQ itself is not in the same position to make the higher high as quick as the S&P is. And it'll be interesting to see if that starts to converge or further diverges from each other. Nick, I want to move on, though, to the volatility index. We obviously have, over the last week, been trading at higher levels. We were obviously for 2 months, 3 months almost, trading in that 12 to 14 level on the VIX. And now we've seen a sustained level above 14. And so obviously vol premiums are rising. What's your take on the VIX here?
Yeah, so with the VIX at around 14, 15 area, you can expect to see top to bottom moves intraday of about 0.75 to 0.8%. Yesterday, for instance, the implied move was 0.68% on SPX. We saw a realized move of 0.75%, and that happened in the last half hour of the day. So again, what we're seeing here is a lot of this option selling, put selling on pullbacks, which is kind of dampening the decline overall. On the flip side, we're seeing almost no call selling now. Yesterday, for example, we saw a huge gamma wrap into close where we pushed from 49.50 all the way to 49.80 in the last half hour. And so it's possible that as we get higher toward the 5,100 area, we see a lot more call selling pick up, which dampens volatility again and kind of gets us stuck in the mud perhaps in between 5,000 and 5,100. Anyways, moving on to page 8, we have the US dollar index here. Eric, what are your thoughts?
Well, last week I said that if we could get the Dixie back under 104, there was still a chance that the apparent breakout above 104.5 was just a knee-jerk reaction to the hot CPI print, soon to be faded. Well, that's exactly what's happened, but so far we're only just barely below 104, and it's not like the dollar's crashing or anything like that. In fact, at 103.75 as I record this, we're hanging right on channel support, so an upside reversal off that trend line is entirely possible right here. But if we can stay under 104, the weakening dollar trend thesis may still have legs. But as I said earlier, I'm going to be glued to my screens on March 12th when the next CPI data release hits the tape. That's when we could see a sudden upset in the dollar trend.
Well, during this consolidation, Eric, the interesting thing is that the yen, the US dollar yen, has really actually continued to hold up. I mean, this was a reaction on that euro, which popped towards 109. So we find ourselves in a situation where really this euro-driven dollar consolidation is now actually coming to a key level on the euro. And so for me, actually watching whether the 109 acts as a resistance on the euro USD is going to be critical. This could quickly find the US dollar back to 104, 104.5 if this was simply just a short-term retracement in that currency.
And moving on to page 9, we have the gold futures chart. What are your thoughts here?
I'm getting increasingly concerned that too many traders, myself included, levered up our gold positions thinking that the Fed's dovish tilt was certain to mean that 2024 would be the year of the breakout to new all-time highs. Now, I still hold the view that higher gold prices are coming sooner or later, and like everyone else, I'm eyeing a sustained breakout over 2087 as a signal that would greenlight an intermediate-term cup and handle target of 27.25. But a second hot CPI print in a row and a sudden change of market sentiment could easily spell a deeper correction down to 1922 or even lower before the bullish long-term fundamentals kick back in. So I'm pretty sure that I'm either going to de-risk or hedge my large long position in gold futures before the March 12th CPI release. Again, I'm still super bullish long term. I just see a very clear setup now for the market to be caught off guard if another hot CPI print spoils the party. And if that happens, it will set up a beautiful buy the deeper dip opportunity around 1922. And I want to have plenty of dry powder ready to seize that opportunity if it happens. We're bouncing nicely off the hot CPI print knee-jerk swing low, and the slow stochastics are only a little past halfway back up. So the current rally probably has a few more days in it before the next swing high, when I'm going to think seriously about de-risking or hedging, at least through March 12th.
Well, with that US dollar weakness, we certainly have a little bit of a risk on, and gold was quite oversold at a major 2,000 round number support line. We saw that reaction, but I'm not going to get excited about gold until we see legitimate price action north of 2,050. If we see that this just fades off of this little rally and find ourselves back at 2,000 in a week, then it just continues to suggest that gold is being distributed. Overall, I think there's a big gold move coming this year, but I don't trust this initial rally here yet. I want to see whether or not the bulls actually follow through on these little bumps, or whether or not this is quickly faded, and it's just too early to tell.
Now, Eric, you mentioned you had some thoughts on uranium. I'm interested in hearing what you have to say about this.
The uranium and uranium mining markets have clearly entered a downside correction, which makes perfect sense in the wake of excessive exuberance putting upside gaps on most uranium stock charts after the spot uranium price broke the $100 round number psychological barrier. We've now taken out the 50-day moving averages decisively to the downside, and most uranium shares and ETFs are approaching or have already tested their 100-day moving averages on Wednesday. If those targets don't hold, the next target lower is the 200-day moving averages. I've already bought the test of the 100-day moving averages in several issues, and I'll add even larger size if we're lucky enough to get a deeper correction all the way down to the 200-day moving averages. While we're on the subject of nuclear energy, I want to put a challenge out to some of our smartest institutional investors. Harley Bassman, if you're listening, this is right up your alley. I would really love to figure out how to fade the utterly nonsensical view that commercial fusion energy is about to become reality at grid scale in the next few years. But I can't figure out what the trade is in public markets. Now, I don't want to short the fusion companies. Fusion is way cool stuff, and it will eventually be profoundly important to the future of energy. Now, that's unlikely to happen in my lifetime, but it will eventually happen, so shorting the companies that are doing the long-term research doesn't really make sense. But even really smart people like Saxo Bank's Steen Jacobsen are talking publicly about claims now being made that the UK will have grid-scale fusion energy pumped into its electric grids by 2030 at the latest. Look, folks, that's not just optimistic or unrealistic. That's plain freaking retarded. I would absolutely love to find a leveraged bet that that's not going to happen using publicly traded financial instruments. So if there are any companies out there that are betting the farm on grid-scale commercial fusion energy becoming reality, not just someday, but in the next 10 years, meaning they fail and go bankrupt if it doesn't happen in that time frame, those are the companies I want to short in massive size. So if anyone can think of a pure play on how to make that bet in the markets, I'd love to hear from you via email to info@MarcoVoices.com. And if anybody wants more color on why these delusional fantasies will never happen in that time frame, the first post at erictownsend.substack.com gives more insight into why these claims about nuclear fusion energy are nonsensical at best.
Now, Eric, on page 10, I have that 50-day moving average on the Sprott Physical Uranium Trust, and we obviously had a bit of a pullback to that moving average. It's still a primary trend. Everything is still in bull trend. But what is interesting is the selling in something like this, the Uranium Trust, has been more pronounced than what we have seen actually on physical spot uranium. And the way to track that, I have on page 11 a chart showing the spot uranium price in orange versus the net asset value of the uranium in the trust. And what you can see is that the closed-end trust is now trading at 11% discount to that of spot uranium. So it very well could be that this Sprott Physical Trust simply has spurred some profit taking on some traders that made some good money and is simply quite oversold and could very easily mean revert back towards its net asset value. One way or another, it's a market that is still in primary bull trend. All bull trends have secondary corrective patterns, and so we're clearly in some sort of a pause, but there's no reason not to believe that this won't be bought on dip. Finally, I wanted to touch on the 10-year Treasury yield. What we have seen is obviously the reacceleration of some of the inflation spur yields higher and create some nervousness in the bond markets. While we could see the 10-year Treasury yield work its way up to 450 basis points, I'm still in the camp that the highs that were put in October and November near 500 basis points are very likely going to be a multi-year high. So to me, as these yields get up here, it will be interesting to see whether that actually creates a bond buying opportunity that going into the second half of the year. Right now, in the short term, the trend is clearly there. Certainly, you highlighted those March inflation numbers, which could be the catalyst that gives these yields one more bump. But other than that, we'll just keep a close eye on this trend. It clearly is still in the favor of bonds consolidating and yields going a little bit higher.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MarcoVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MarcoVoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.